Hi there. PMI, private mortgage insurance. What is it? What is PMI? So rewind dozens of years ago, back in the 80s, 1980s, private mortgage insurance was created for lenders to be able to loan with people less than a 20% down payment. Back when my parents were buying houses, 20% down was the norm. If you didn't have 20% down, forget it, no house. So a group of people got together and said, hey, let's create this product that's an insurance product that's for the lender so that if the buyer forecloses, the lender gets paid. It's like an insurance policy. If the house burns down, there's money to rebuild the house, right? Well, the same thing. So it's an insurance for the lender, but yes, the buyer does pay for it. It's the risk additional assessment for having the opportunity and the privilege to put less than 20% down. So there's two types of loans. There's conventional loans, which I'll go over the details on that, and then there's FHA loans, Federal Housing Administration. PMI is different on those two types of loans. So first I'll go over a conventional loan. A conventional loan, again, you need to put 20% down to avoid the PMI. So if you're putting less than 20% down, the cost of the mortgage insurance, please watch our video on how to calculate PMI, but the cost of the mortgage insurance will depend on how the number of borrowers on the loan, the credit score, and the down payment. So the more money you put down and get closer to the 80% loan to value, or the higher your credit score, or the more borrowers that are on the loan, those have better rates. So the rates do change, so I'm not going to quote the rates here, but the better credit you have, the better the PMI rate. So it's a monthly. There's also different types of PMI. So I'm just talking mostly about the monthly. That's the most common. So that's what it is. And again, I've got a video also as well on the 4 types of PMI. So feel free after you watch this one to watch that one. So the other type of loan is an FHA loan. An FHA, Federal Housing Administration, since those loans are more lenient on many aspects of credit, really borrowers, it allows higher debt to income ratios. The PMI, it's actually called MIP, Mortgage Insurance Premium, and it's actually mandatory on the loan no matter how much you put down. So even if you put 20+% down, the mortgage insurance is still required. Now the mortgage insurance is in 2 ways. It is a 1.75% times the loan amount added to the loan amount, and in addition it's a monthly amount. So I do have another video on how to calculate PMI, so you could watch that as well. Now on the PMI on FHA, if you put 10% down and are a 15-year loan, the PMI is only for 11 years before it's waived. Or if you put less than that down and you're on a 30-year loan, you do have to pay the PMI or the MIP, mortgage insurance premium, for the life of the loan. So it's very important to know that. Talk to your local lender about these 2 types of loans and the PMI or MIP and how that affects you. Hope you got a lot from this video. If you're in Texas, call us. Legacy Mutual Mortgage is an equal housing opportunity lender. The opinions expressed here do not reflect those of Legacy Mutual Mortgage.